Hello and welcome to CMS Forex Daily Market Recap. I'm CMS Market Analyst Nick Nassad, and today is Wednesday, October 28th, 2009. We first take a look at the US dollar Japanese yen pair, as today's action was highlighted by a very strong move in favor of the yen. The initial slide began in the Asian trading as stocks in Japan and other regional stock markets fell on worries about the strength of the global economic recovery. Japan's Nikkei 225 ended down about 1.4%, the Shanghai Composite Index lost 2.8%, and Australia's S&P ASX 200 was off about 1.4%. That was responsible for this initial slide in the pair, and the worries and the risk aversion carried over into European trading and then into the New York session. We showed yesterday how the dollar-yen pair had moved below an upward sloping trend line, and today we had even further follow through of yen strength. If we go back a little bit further, we see that today's support came at around the 50% Fibonacci retracement of this most recent rally. As you see here, once we did find that support, the pair was able to counter rally somewhat in very late New York trading. The euro-yen, meanwhile, extended into a third day of declines, with today's move being the sharpest compared to the previous two sessions. Today's fall amounted to about 260 pips from high to low, and we punched through this support, this consolidation zone that had been between the 136 and about the 135 level. The sharp drop here came at around 1 p.m. New York time, which coincided with the auction of 5-year Treasury notes, about 41 billion worth, and the auction drew pretty decent demand, which offered evidence that safer investments are still in favor. There were two reports from the US today, one positive and one negative. First, let's take a look at the durable goods orders, which showed orders bouncing back from a drop of 2.6% in August, and this month for September they came in at 1%. The gain is the fourth in the last 6 months and is a favorable sign for the economy as the manufacturing sector is expanding and leading a recovery. The data show that orders excluding transportation were up 0.9%, while a key indicator of capital investment, the non-defense capital goods excluding aircraft index, rose 2.5%, the first increase in 3 months. On a negative note, the U.S. home sales fell 3.6% to an annualized pace of 402,000, a figure that disappointed forecasts. With the expiration of the government's $8,000 first-time homebuyer tax credit coming up at the end of November, the data will fuel concerns that the housing market may retrench in the coming months. The new home sales data added pressure to U.S. stocks and increased the sense of risk aversion that had already been present in the Asian and European sessions. The euro-dollar pair had similar price action to yesterday, when a counter rally in Asian trading was met by selling of the pair in European and then US trading. Today's low near 1.47 comes at an important Fibonacci retracement level of the most recent rally. As we see here, the fall stopped right at the 61.8% level after we had a bounce up of 50% in yesterday's session, and we consolidated between 50 and 38.2%. In New York trading, we broke below that level until we reached the next Fibonacci zone. We also see that the 3-session decline this week has been a much steeper pace than the actual rally, which took a more gradual approach until it reached 1.50 here. What we can gather from that is that there was a good amount of selling pressure as soon as we got some bearish data as we reached this pretty important psychological price target. If we take a look at the pound-dollar pair, we see a pretty different development in that the pound was able to hold its own against the dollar, bouncing up of support near 1.63. We did rally after that test of support, pushing above yesterday's high, but only for a brief moment, and it looks mainly like we're in a bit of sideways trading at this point. Still it is evident that the pound is much stronger than the euro this week, so let's take a look at a comparison of the two currencies against each other. We see here that the euro-pound pair fell rather sharply in favor of the pound in today's New York trading, with most of it coming after the New York Open. We punched below the 0.90 level, which was important support last week, and if we zoom this chart back, we see that that support went back to about September 22nd, while today's low goes back to September 17th. We're also seeing a bit of a head and shoulders pattern with our neckline at 0.90 here, though it's not perfect as this initial move down didn't actually touch the neckline, so it's similar to head and shoulders. Taking a look at another fundamental release, this one from late last evening. Consumer inflation in Australia rose by 1% in the third quarter, a pace that was slightly higher than forecast and higher than the 0.5% pace set in the second quarter. However, on an annual basis, inflation grew by 1.3%, which was weaker than in the previous quarter and is actually the slowest pace of annual inflation in nearly 10 years. Still, the 1.3% increase was slightly higher than forecast. In a look at the Australian dollar-US dollar pair, we see that overnight the release heavily weakened the Aussie as it broke below support at 0.9125. The pair then retested that level as now resistance and continued to decline in the face of higher risk aversion in today's trading. The reason for the decline is that lower inflation can cause the Reserve Bank of Australia to slow the pace of its interest rate increases. The Reserve Bank of Australia was the first central bank out of the group of 20 nations to raise rates, and that helped Aussie to rally very strongly throughout most of October. However, here we see what looks like a rounded top, and following the break of that support I just mentioned, we had a pretty steep decline in today's trading. The New Zealand dollar-US dollar pair also saw a very strong slide in favor of the greenback. Throughout most of the session, weaker stocks, lower commodity prices, and increased risk aversion were the main catalyst for the fall in the pair, but just recently in the last 30 minutes we saw another leg down as a result of the New Zealand central bank's decision, in which it sounded rather dovish about the pace at which it expects to increase interest rates. Reading from the statement, the final part of the statement reads, "In contrast to current market pricing, we see no urgency to begin withdrawing monetary policy stimulus, and we expect to keep the official cash rate at the current level until the second half of 2010. Again, similar to some of the other pairs we looked at today, the sharp slide here was faster than the run-up, which took about 3 weeks, and now we're back to where we started pretty much on October 2nd. If we zoom out a little bit, we see that there's a consolidation zone here, and we've just broken into the upper part of this resistance area of an old consolidation zone. Finally, we'll take a look at a third quote-unquote commodity currency pair, the US dollar Canadian dollar, and we saw an extension of the greenback's gains that started around October 14th. We moved above resistance at 1.07, which we see acted as support before the Canadian dollar saw very strong gains in the first half of October. If we zoom in, we see that following the break, we did retest that 1.07 level, and it now acted as support, and then the greenback was able to move higher to about 1.08 as a high for today's session. And that'll do it for today's market highlights. So let's take a look at some upcoming releases. From New Zealand, we'll have trade balance. Australia posts its WMI leading index. Japan posts its industrial production and the corporate service price index, a measure of inflation for companies. Overnight, Germany releases its unemployment change. The UK posts consumer lending and mortgage approval figures, and the Eurozone will release its end-of-the-month economic sentiment and business climate indicators. Tomorrow, the US posts its advanced release of third quarter GDP, which is expected to increase 3.1%, which would technically mean that the US is moved out of recession in the third quarter. We'll also have weekly jobless claims, and from Canada, producer prices. And that'll do it for today's daily market recap. Thank you for joining us here at cmsfx.com, and happy trading.